usually the subject of investment, I think, warrants a conference by itself. So I don't know if we will be doing justice to give it only a paper within our conference, and I hope it will encourage the need to set up a conference only on investment of pension funds. In the meantime, in the absence, because we know that few people are still delayed in the praying, we will take the liberty of starting. I will ask Dr. Shadi Karam to introduce Merrill Lynch to us quickly, where then we will have Peter Lockyer deliver his paper.
Good morning, ladies and gentlemen. I'm going to be very brief, so I'm not going to at all penalize the record of half an hour delay that Brahim has been very proud of saying he set. We're very happy and very proud to be here. Our firm has been very attached to this region. It has been very attached to this region over many, many years, and our presence in Dubai, in Abu Dhabi, and here in Bahrain goes back many years and is very deeply ingrained. And we've tried to serve our institutional and private clients alike during those years with great faithfulness, and we're very happy to do that. Now, Brahim mentioned earlier on that I'll be flexing some muscles, as he says. Well, indeed, I am going to be flexing some muscles, because Merrill Lynch has done a lot of bodybuilding in the past years, and quite efficiently so, and without steroids, I may add. We are today one of the prime financial services companies. We weigh over 1.5 trillion US dollars. That's $1,500 billion of clients' assets. But our financial strength is not really the real image. Our strength lies mainly in an unparalleled research capability, and also in a team of people. We have an army of analysts that are second to none, and who canvass the world, who make over 6,000 visits yearly to companies worldwide. Over and above that, our strength lies in the respect of our commitments and the integrity of our principles, and also in the people that staff our company. Top quality professionals, second to none, who service institutional and private clients alike through a network that extends from Monte Carlo, where I come from, to Singapore, from Buenos Aires to Bahrain. And one of the most performing teams of the company, the people from our Bahrain office here, they are hosting us this evening, and you will have the opportunity to meet with all of them. They are at your disposal. They join me to be at your disposal during this conference in order to answer any query you may have, covering the full spectrum of financial products and services. Now, so much for the commercials, Brahim. I'll stop here. Let me take you through a very brief overview of Merrill Lynch. Can we just back up, please, one slide? You're going too quickly for me. The four businesses that we are engaged in are the corporate and institutional client group, where you have the investment banking, corporate finance activity, the asset management group, which interests us most today, and the private client group, both the domestic and the US and the international. Now, the asset management group, as you see, is divided into two parts, but these are not two separate parts, really. They operate in perfect symbiosis, perfect harmony, and they exploit every synergy you can exploit. I can never find how these things function. There we go. Now, as you can see, when we get to the numbers, the assets under management overall for both branches have reached over $514 billion at the end of the third quarter last year. More importantly, you have 366 investment professionals covering a wide range of geographic allocations. There isn't one single financial center, major financial center in the world where we are not implanted. They also cover a wide range of asset classes. The specific part that Mercury has under management weighs $259 billion as of the end of the third quarter. Makes it one of the leading investment management firms in the world. To add to this, let me give you a few more highlights. Merrill Lynch Mercury Asset Management is currently managing money for 5 of the 10 largest pension funds in the world. That is pretty impressive. 59 of the 100 largest UK corporations, 25 of the 50 largest Japanese corporations, and 17 central banks on 4 continents. The slide says in more than 4 continents. I really don't understand how we managed that. But it is on 4 continents. As of the end of the year last year, we managed in excess of 5,000 client portfolios. The important thing about Peter's team and what Peter's team does is really that they address the problem from a risk management viewpoint. They go beyond which investments to hold. They go beyond advising you on what to buy and what not to buy. What is important is that they create an analytical framework that concentrates on addressing the needs of each of our clients, institutional and otherwise. And the way they do that is by integrating all the parameters of a client's situation. And in order to do that, you really need to understand clients' objectives, understand them deeply. And this cannot be a static process because situations change, markets develop. Even the intrinsic changes in the client's situation impose new views on you. So I will leave it to Peter to develop these aspects of their work in detail. I will just briefly tell you who he is. He joined Mercury last April, 1999. He was before that working at Aon Consulting, where he headed the firm's investment consulting practice. He was educated at Bristol University and is now responsible for setting long-term investment strategy at Merrill Lynch Mercury Asset Management. Peter?
Thank you, Mr. Chairman. What I want to talk about is investment strategy. Principally, it's about the strategic balance between different assets that will maximize the possibility that a pension fund will meet its objectives. The investment returns that you achieve on pension fund assets will have a crucial bearing on the cost of providing those benefits or the size of the benefits themselves in a defined contribution scheme. And in that investment, in those investments, the investment strategy is the single most important decision that can be taken. There are several academic papers which have shown that variation in investment strategy is the most important issue involved in it. There is a wide range of different ways that people can come up with in terms of getting higher returns, some of which will work and some of which won't. But there is one fundamental way in which any institution can guarantee underperformance or dissatisfaction, and that is to constantly change its investment strategy. And that really emphasizes the importance of setting the right strategic benchmark. So what I want to cover is really investors and investments characteristics, what goes into making up an investment strategy, some of the problems in developing strategies, then looking at the overall structure of a fund in terms of risk budgeting, about how the various parts of the fund interact, and finally, a topic which has cropped up already this morning, defined contribution schemes. What does investment strategy mean for a defined contribution scheme? Well, the starting point is really investors and investment characteristics. And what I've done here is just set down 8 characteristics which apply to all investors wherever they are in the world. Regardless of whether you're a private individual, any form of endowment, a pension fund, even an insurance fund, these 8 characteristics apply to you. What varies between different funds and different positions is the weights given to the different factors. The liabilities, are they for pensions or for lump sums? Will the pensions be increased to take account of inflation? What's the duration or the time horizon? Are you going to pay these benefits in a year or in 10 years' time? The amount of money that you have, the solvency, the ratio of the assets to the liabilities, that fundamentally affects the way in which the strategy you can follow. Your need for income. Do you actually need to have to pay out lots of benefits in the short term, and therefore you need more income to do that? Risk aversion. How willing are you to suffer underperformance in the short term in the goal of getting better returns over the longer term? And finally, the tax position, whether there are any tax reasons which influence the way in which the funds may be invested. And liquidity. Is there a possibility that unexpected or unanticipated events could force you to realise investments at inopportune times? But those 8 factors apply to any institution or any investor anywhere in the world, regardless of what they are. So that's the investor. What about the investment characteristics? Well, it is relatively simply shown on this chart. All investors face this choice between 2 assets, asset A and asset B, both of which are expected to give the same return, but there's different levels of certainty about that return. There's far more certainty about the return from asset A in terms of its distribution of returns over the time period. Well, faced with that choice, it's fairly obvious that most investors would choose asset A. You've got the same expected return and more certainty. But the issue is, if asset B started to give you a greater expected return, how would you favour it? How much greater does the return have to be from asset B compared to asset A for you to accept that greater uncertainty? And then also, can you mix these 2 assets together to give you a better pattern of certainty and return? And it's really, this is the fundamental issues in setting any sort of strategic benchmark in terms of marrying up the uncertainty with the expectations of the returns that you might have. And we actually see this across all the markets in the world. In this chart, I've shown the cumulative return from US equities, US bonds and cash over the period since 1985. And you can see that over that time, an investor in equities would have achieved a return substantially in excess of the return in bonds and the return on cash investments. The point about this graph is that if an investor was looking to meet pension liabilities at the end of 1999, he would have had to have 1/6 of the amount of money invested in equities at the outset that he did if he was investing in bonds or cash deposits. It shows the effect of long-term extra returns that have been achieved on equities. But the problem is that those long-term higher returns have come at a cost for all investors. And the cost is very much higher, short-term volatility or uncertainty in return. And what this graph shows is the returns over 12-month periods from each of those 3 asset classes. And you can see that although equities gave you the much higher return over the full 15-year period, there were several periods of 12 months when they gave negative returns. You'd have had less funds returned to you than you actually had invested in particular periods, 1988, 1990, 94 being at the highlights. And you can see that there's quite a lot of uncertainty involved in investing in equities compared to bonds and cash investment. And it's the whole issue about weighing up this sort of uncertainty against these higher returns, which is the issue in strategic benchmarks. And as I said, it is actually reproduced in all the markets around the world. I've chosen these 5 main markets for investments: Germany, Japan, Switzerland, the UK and the US. And you can see in each case, bar the Japan, that the hierarchy of returns has been the same. That the highest return has come from equities, followed by bonds and then by cash investments. And you can see that you have achieved the higher returns in each of the asset classes. If you look at the UK, going back to this point about the cost of benefits, in the UK over that decade, equities are given a 2% greater return than bonds per annum. But 2% per annum for 10 years would reduce the cost of the pension benefits by over a third. Alternatively, if it's a defined contribution scheme, it would mean the beneficiary would get a benefit 1/3 as great as he would get if he solely invested in bonds. But again, it's the same point in terms of volatility. What this graph shows is a statistical measure of the volatility of each of those asset classes. And you can see that you get very much greater volatility from equities than from bonds or from cash. And that if investors do invest their money in equities, they have to be able to withstand that sort of volatility, especially if they're pension funds where the matching asset or the secure asset which will meet their objectives is bond denominated. So how do we actually go about developing an investment strategy? Well, the first aspect is really to define out what the risk is in any particular investment. And risk is used quite a lot in investment world, but the way which we tend to use it in terms of investment strategy is that risk is the probability of not meeting your obligations to pay out pensions or lump sums or meet the liabilities which you've undertaken. And the starting point for any sort of investment strategy is to look at those investments which actually minimize the possibility that that will occur. If you have an obligation to pay pensions in 10 years' time, the assets which match that obligation are classically bond investments. If they're shorter term, over 12 months or so, then they're matched more by cash investments. But those are really the matching investments that you have. The issue comes down to how far you can move away from those matching investments and invest in equities for the higher return, given the greater uncertainty that you get from equities. Well, that's really the theory. What are the sort of problems that we have when developing a strategy? And really, the biggest single problem, or the first problem that comes up for most funds is really what are the obligations that they face. Most of us understand the obligations in terms of pensions being paid in 10, 20 years' time. But before that, we have actuarial assessment of those obligations. We have actuaries producing valuations saying these are the states of the funds, these are the nature of what the obligations are. And what happens is that these perceptions about how the funding or how the actuarial valuations are done actually interfere with the reality of meeting the benefits over the long term. An issue which has arisen in a lot of European countries is that the actuarial tests being used to assess the state of funding actually become more important than the obligations themselves. The next issue is one of practical implementation. An issue for many funds, especially when they change their strategy, is actually can they buy enough, does enough of the asset they wish to buy actually exist? It's no good saying my investment strategy is going to invest in a certain sort of bond if those bonds themselves are not available or not liquid enough for you to buy. There's also the other problem when some of these state schemes are changing their strategies, is that they hold so many assets, such a big proportion of particular assets that when they come to sell, they depress the market against them. It is an important issue in terms of any investment strategy that it is practical and can be implemented. And then the next problem is what we term as utility function. It's really the most difficult and intractable problem that all investors face, which is really working out how they feel about underperformance and outperformance. As I said, investment strategy is about determining how much you wish to move from mismatched assets into higher returning assets, but by doing so there is a potential for underperformance. And how we like to illustrate this to clients and internally is with this graph here. Theoretically, people think of themselves as a rational being in terms of the red line, that if they have their matching asset and they underperform their matching asset by 2%, they're twice as unhappy as if they underperformed it by 1%. And if they outperform it by 2%, they're twice as happy as if they outperform it by 1%, and has equal level of happiness as unhappiness with 2% underperformance. But we know from our experience with investors and with clients is that for most people, the reaction is not that way. The reaction is much more like the green line with that slightly concave shape. Each unit of outperformance doesn't actually give you an incremental unit of happiness, and each unit of underperformance actually gives you greater levels of dissatisfaction and unhappiness. The problem is that we can't actually quantify that relationship. It's just something that we know that occurs. But in terms of setting investment strategy, what is important is actually to understand your sensitivity to potential underperformance over the short term or the medium term, because that determines how much mismatching of the matching assets you can stand. The next issue is liability uncertainty. One of the questions raised earlier this morning was about early retirement options. As an actuary, when I was practicing, I used to delight in saying to trustees, oh, here are your cash flows going out based on life expectancy tables. But any form of demographic projection includes some sort of uncertainty. The liabilities aren't as certain as the actuary will make out in his valuations. Also, the existence of options, retirement options, in the liabilities leads to some uncertainty in the pattern of payments that will occur. Now, it does have an impact on what are the matching assets. What this graph is showing is saying if you have a matching asset and you invest all the money in it, you would have 100% probability of getting a zero surplus or zero deficit. So you get a straight black line straight up the 0 point. But because there's some uncertainty in your liabilities, the actual outcome is going to vary away from that zero position. If you allow for a modest amount of uncertainty in your liabilities, 2.5%, you get the blue line. And what that's saying is that with just that 2.5% uncertainty, there's about a 2% probability that you're going to suffer a deficit of 5% in your liabilities, even though you've bought what you thought was a perfectly matching asset. What's happened is you've matched out what the actuary said will occur, but because events haven't occurred as the actuary said, you've now got a deficit in your scheme. And as the uncertainty increases, so the probability of deficits or surpluses rises. Well, in terms of setting your investment strategy, you can actually counteract that uncertainty. You can look at the uncertainty on the asset side. As I said, there is uncertainty on your mismatched asset, on your equity investments, or whatever they may be. And you can get a similar pattern of uncertain distribution of outcome by investing part of the money in your mismatched asset. Now, if your mismatched asset and your liability uncertainty aren't related to each other, by mixing these two together, you can actually get a better pattern of outcome for the fund than would be the case by purely matching. We've done modelling on this and allowing for the sort of typical liability uncertainty that most pension funds have, purely matching out the actuary's assumptions in terms of mortality and options in the schemes and the benefit design, allowing for a modest 2.5% liability noise or liability uncertainty would mean that the actual matching asset, or the one which minimizes the probability of deficits, would actually give you about 20% in equities or the mismatched asset. The point about this is that you're diversifying out the risks involved in your pension arrangement. Because of the uncertainty that you've got in your liabilities, you can take diversifying positions in the asset mix. The next issue is really the issue of time horizons and the consequences of that on investment mismatching. If your obligation is in 10 years' time, then intuitively you can actually afford to have more invested outside the matching asset of bonds into other asset classes than if you were investing to meet your obligations in 12 months' time. And that's confirmed in this graph, which looks at the probability of having insufficient assets, assuming the fund is initially in equilibrium, and you invest 50% in a mismatched asset. As you can see, the probability of underfunding reduces with the longer time horizon for your obligation, demonstrating that as you have a longer time horizon, so you can afford to take a greater position into mismatched assets. The problem with that is that most long-term investors of pension funds, state retirement schemes, whatever, are also subject not just to the long-term test of whether you're going to pay the benefits in 20 years' time, but short-term tests about solvency. They're subject to these short-term tests at multiple objectives. In addition to which, is it really practical to look out 10, 15 years in terms of setting your investment strategy? So much can change in that time. Isn't it better to set something which is more practical in view of the time horizons of investments and the evolution of capital markets? Again, theoretically and practically, the optimum time horizon for setting investment strategies is around 5 to 8 years. It's that sort of time horizon which establishes the benefits of any strategy for the investor. Our conclusions are really that long-term investors are really satisfied with the analysis of their pension, their position after 5 years, but also they need some indication of the consequences of over the shorter term. But much more important than the time horizon in terms of setting investment strategy is the amount of surplus that the fund has. That's the ratio of the free assets in excess of the obligations that the fund has. Surplus is fundamental to the way in which funds can invest. Surplus provides protection in the short term against those adverse movements in markets that I illustrated earlier. And just to illustrate that, what we've shown here is really the probability of insolvency depending on varying proportions invested in the mismatched asset and different levels of initial surplus. And what this shows is that the proportion of mismatching that can be undertaken by a fund increases quite dramatically with increases in the surplus. A surplus of 15% permits a fund to move 45% of its assets into the mismatched asset. A surplus of 20% allows it to move up to 60%, with that same constraint of the probability of insolvency. So really our conclusions on time and surplus are really that the practical and theoretical time horizon of most investors is much shorter than their perception, that most investors don't have time horizons of 10 or 20 years, that need to look at about setting strategy over the sort of 5 to 8 year period. And in terms of importance in terms of setting the strategy, what's most important is your objective, your utility function, your ability to withstand short-term adverse movements in the investments, your surplus in terms of the funding of the scheme, and its ability to withstand those same fluctuations. And then finally, the time horizon, the duration of your obligations. In terms of investment strategy, one of the techniques which is now used in terms of formulating investment policies is a concept called risk budgeting. The concept is that any investment fund has a variety of different risks in it, and it's necessary to look at how all these risks interrelate to gauge how the fund should operate and to make sure that the risks are appropriate to the fund. All investors have the same objectives. What they're trying to do is to make sure that the rewards that they achieve for their fund in terms of the risks that they're taken are commensurate. They are being rewarded for the risks in the fund. They don't want to be exposed to unexpected or unwanted risks. There's nothing in the fund which is just a byproduct of a series of other decisions, but will have actually the biggest determinant factor on their investment returns. And finally, they want clarity of roles and responsibilities to ensure that all the risks in the fund are actually being managed and monitored. So that's the three basic objectives in terms of managing the fund. How do you actually go about risk budgeting? Well, it's like all budgeting processes. The first step is actually to work out the total amount of risk that you can take in the fund. If you can afford different levels of underperformance with different probabilities, then you can afford different levels of risk. So if you can afford the fund to underperform over a 12-month period by 5%, say 1 year in 20, you might go for Fund A. If you can afford it to happen 1 year in 6, you might go for Fund B. But it's about the total amount of risk that can be taken in the fund. So you would determine the total amount, you then allocate out that risk to the various components in the fund. What I've shown on the left-hand side is a sort of hypothecated allocation of the risk. What is important in that block is really the first blue box, which is down as benchmark risk or strategy risk. It just emphasizes the point that in any investment fund, the biggest single source of risk that's been taken is actually the strategic benchmark, the benchmark risk in the fund, the fact that the benchmark itself is not the same as the matching assets. Then in addition to that, you'll have other risks being taken in the fund because you have active equity managers, active bond management, and so on. The point about risk budgeting is to bring all these different elements together in a way that add up in a way which is satisfactory to you. The point is that some of these risks aren't actually correlated with each other, are independent of each other, which means that when you add them together, you have to take some account of that. And to illustrate that point, I look at benchmark risk, the risk of moving into equities even though your matching assets are bonds, against having an active equity manager. If you decide to invest in equities and your matching assets are bonds, you're taking a benchmark risk of about 13%. A typical active equity manager takes an active risk of about 4%. So if you might think by appointing an active manager, you're taking active risk, total risk of 17. But these two risks aren't actually perfectly correlated to each other. They're actually independent. And what that means is that when you add the two together, the actual addition to the total risk in the fund is much more modest. But it does emphasize that the majority of the risk that's being taken in a fund and in most investments is actually the benchmark risk, the strategic benchmark or mix that you've determined. There's a series of different risks that are run in all investment funds. What I've done here is just pair out several of them to make some comments about the way they interrelate. As I said, benchmark risk and active equity risk tend to be independent of each other and therefore will not add together in a portfolio. active equity risk in different equity markets is also independent of each other. We've done a very big study, not just on our own performance, but on the performance of US fund managers and UK fund managers, and demonstrated that the active equity risk that managers take in different markets is actually independent of themselves. In bond portfolios, there's two different types of risk. There's duration risk, the duration of the bond portfolio, and credit risk. Again, having analysed these, the conclusion was that these two risks are independent. And then finally, I've got here is currency risk. In any non-domestic security, there's currency risk is brought in, either in bond portfolios or equity portfolios. Currency risk appears to add to the risks in a portfolio. The issue for all investors when looking at currency, either in bonds or in equities, is whether they're being rewarded for that extra risk from taking currency positions. There seems to be a gathering body of work which is suggesting that currency risk just adds risk to portfolios with no actual reward, and that the correct position for most investors to start with for both equities and bonds is to actually remove currency from their portfolios. So risk budgeting, to summarise, it's about starting with determining out your safe harbour, your matching assets, then determining out the level of risk that you can accept and that you can take, and then allocating that risk out to the various elements that are in the portfolio. To allocate it out to benchmark risk, how much you want to move into the mismatching asset, active equity risk, using active managers, and active bond risk, taking into account the interaction between these different risks and the potential rewards that you could get. Really, that's looking at investment strategy for defined benefit schemes. But I think it's quite important to consider investment strategy for defined contribution schemes. Employers, when they provide defined contribution schemes, are faced with a dilemma that they wish to offer their employees the greatest possible choice of funds and types of investments, but also they want to ensure that the employees don't make the wrong choice. They have a very paternalistic attitude that they want the employees to make informed choice, but also not to do things which will be detrimental to their interests. And really we've seen this in the way that defined contribution scheme strategy has developed over the last 20 years. During the 1980s, it was very much dominated by insurance policies, limited choice, but very much capital guarantees for all the employees of the scheme. That the employees would be guaranteed a minimum level of return on their contributions into the fund, and would be guaranteed that the fund would have a certain capital at the date of their retirement. What happened during that time was that people realised that providing these capital guarantees for very young employees was not only very costly, but also not actually something that they required. A very young employee who doesn't face retirement for 20 or 30 years doesn't require a capital guarantee. He can rely on, or he should aim to get a higher return. So what we've seen over the last 10 years is an increase in the choice being offered to the employees, and this concern about what's termed as reckless conservatism. That employees were too concerned about short-term fluctuations in the value of their funds and not concerned enough about maximising the potential returns that they could get. The problem with offering employees funds with high equity content is that they remain in those funds up until retirement, and unfortunately they retire at inopportune moments when equity markets are depressed and when bond yields are very low and the cost of annuities is high. And for that reason, what's developed more recently is what's known as lifestyle funds, these have been designed to actually get around this problem whereby young members put too much of their money into bond-based funds and older members put too much of their money into equity funds. And the basis of these is illustrated in this particular chart, where what would happen is that the funds are automatically moved on behalf of the employee between equities and bonds, depending on their age. So that when members are very young and what they require is sort of the higher return, and that short-term fluctuations in markets are not that much concern to them, the funds are predominantly invested in equities. As they approach retirement, the funds are then gradually moved across into bonds. And this is done to enable members to take advantage of the sort of financial planning which is available to individuals on a cost-effective basis. And it's quite interesting that there's been a paper looking at private individuals' investments in the US market prior to the introduction of lifestyle funds, and actually showed that the typical private investor in the US was following that sort of pattern, and therefore its introduction into large numbers of pension schemes was not just theoretically correct, but was sort of reflected how people would behave in real life. So really, to conclude, the most important single decision in terms of any investment policy for defined contribution or defined benefit scheme is the long-term investment strategy. The mix between equities, bonds, is the crucial one in terms of determining the level of performance that you will achieve and the cost of providing those benefits. The key to understanding or determining what is the right mix for any particular fund is really determining the sensitivity to short-term underperformance of your matching assets, how much tolerance there is to that sort of mismatching or underperformance. And once you understand that, you can go forward in setting an investment strategy which hopefully will reduce the cost of the benefits or provide better benefits for the beneficiaries. Thank you.